Okay, guys, we got a lot of stuff to cover. So here's a very general overview of what we're going to be doing. General introduction, very fast. I'm going to give you an overview, real fast overview of the areas we're going to cover. And I have to say that any one of these areas by themselves could be a 2-3 hour seminar. So if you feel overwhelmed here, it's a summary. So just know there's a lot of information here, and I'm not going to go as deep dive, but I think when you finish being here, I think you're going to have a grasp of at least what's out there, as opposed to, finding out the hard way. And then after giving you the overview, we'll delve into the topics. I'm going to spend a lot of time on the presentation of financial statements, which are effective this year and involve every single not-for-profit. The contributions received and made, that's a new FASB that came out effective next year. We'll talk about that. Revenue with contracts with customers affects every organization, not just not-for-profits, and is voluminous. The FASB is this thick. So if you have trouble sleeping, I recommend that one. And leases, which doesn't seem like a big deal, it's not going to be effective for a couple of years, but it's going to affect every organization, and a lot of organizations are not going to want to have to comply with it, but they have to. So I'll get to leases if we have time. I always say with time because historically I run out of time. I understand we can be in the room a little after 3 o'clock, so I will stay here as long until they kick me out and kick you out. And if you have questions, I'll be happy to answer. And those that I can't answer, you can send me an email. And those that know me, I'll answer your email as quickly as I can. Okay. Some of you have seen this before. A good number of you know me. So for those that don't know me, the minority in here, my name's Lawrence Scott. People call me Larry. People call me a lot of things, actually, but we'll stay with Larry, especially when I'm doing audits. My firm is Scotty Scott & Company. We are a boutique CPA firm. Boutique because we have under 15 people, and we perform up to about 110 audits. We prepare over 550 990s, 990EZs, and we do consulting work for a number of not-for-profits. Our not-for-profits are startups, after-school programs, 20,000, 10,000, all the way up to a bank foundation that we have. In addition to my day job, which is what pays my bills and pays for my son's college, I also teach. I've taught undergraduate, graduate, and I've been giving seminars for 20 years. And so, in addition to teaching, I've also sat on boards. So for you guys that deal with board of directors, I've been on boards. I know the politics, both being on the board, being an officer, and as a person working with the not-for-profit. So I see a very unique perspective on both sides of the aisle. Anything else to tell you? Oh. For most of you, or a lot of you know this, I've created a certificate program at different schools. A number of you have come from NYU, which was a long time ago. I started it in 2000 and, you guys could correct it, 2008, I think, and ended it when NYU killed all their programs. I moved over to Baruch. I was doing it here for Baruch. The person who ran the department at NYU went to Fordham. They asked me to bring it over. I went over to Fordham. I did it last year. And I might be back at Baruch this year. Just a general question. So a lot of you work for not-for-profits. Just so I get a feel, how many of you work with financial statements? Wow. So a good guess I would be 60, 70%. Okay, so the first section is really going to appeal to you. Okay. Quick overview, very quick, and then we'll do a deeper dive. Before I say to you what the rule is, where's the rule coming from? The rule-making body in the United States is called the Financial Accounting Standards Board. Some of you have heard the acronym, the FASB. They're the ones that put out the pronouncements. Years ago, before that, was the AICPA. They took over in '73, and since then, they've been the sole rulemaking. The rules that they make, you guys have heard this. A lot of people don't know what it means, but we've heard it, which is generally accepted accounting principles, general accepted accounting principles, or GAAP. People don't know that GAAP is a kind of a combination of rules that have been around literally for 100 years in different formats. It used to be statements of financial accounting standards. It used to be accounting research bulletins, ARBs, and then accounting publication bulletins, APBs. And now FASB has taken all of the accounting rules and kind of melded them together and put it in a giant tome called the Accounting Standards Codification. The acronym is ASC. And actually this is pretty good, because up to now, people were citing old rules, like they would go FASB 15. Or for those that have been doing accounting for a little while, you probably have heard the accounting standards, financial standards that came out in 1993 called 116 and 117. One was contributions, one was financial statement. That was the first set of real hard rules that have come out. Nothing has come out until now. It's a long time, right? And the way that the Accounting Standards Codification works, the ASC, is they have topics and subtopics, and they drill down. And the reason for telling you, look, most of you are not really going to care about the number, but when you read the financial statement, the report, the auditor's report, you're going to see references to this. And I just wanted to tell you what it is, so you know. You're going to see, in accordance with ASC 958, that's the not-for-profit entity, subtopic 205, it's presentation of financial statements. You're going to see that mentioned. And so that's where it's coming from the FASB and that codification. Now, when the accounting bodies want to make a change to the rules, it's called an update. Instead of a new number going to 117, 120, 130, 140, it's called Accounting Standards Update, ASU. And for all of us who work for not-for-profit, we are fortunate that they came out with a slew of them in the last couple of years. Now, do I think that all these rules are needed? I think a lot of them are. Do I think that they are a little overkill? I think some of them are. A lot of these rules are really fomented to deal with large institutions. Unfortunately, there's no two separate gaps. We talked about it at the AICPA years ago, having big gap and little gap. Big gap for the big companies, little gap for small companies. And it was decided years ago they didn't want to have two sets of accounting rules. And you might say, what's the difference? Who cares? The trouble is we all have to follow the same rules that a $100 million not-for-profit, a $200 million not-for-profit has to follow. And okay, it's not as voluminous because it's not as many programs and activities, but it's still the same set of rules. And unfortunately, we all have to comply. And it's very hard for a lot of you that work in an accounting department that has 3 people, 2 people, 1 person, a half a person. And you know about the half a person, you guys, so I don't have to elaborate, the part-timers. And you have to comply with the same set of rules. And there's not a lot of information out there of what you have to comply, and you can hear smatterings of it. So we're going to talk about the major ones affecting the not-for-profits today. And like I said, we have less than 2 hours. They originally wanted an hour and a half. They agreed to 2 hours. Any one of these subjects I'm going to talk about could be 2 hours by themselves. Okay, so again, here are the 4 major updates with their numbers. Presentation of Financial Accounting Standards, ASU 21614, effective this year. clarifying the scope of accounting guidance for contributions received and contributions made, very important for public charities. Okay, that's ASU 216-08. Revenue from contracts with customers, which is also effective next year, which is 2019, but 2020, 214-09. And operating leases, which we have a little time for, is 216-02. And that's the copy of the actual book that nobody wants to read, unless you're suicidal. Okay. Let's delve right into the statement of the financial statements. What I did on these slides is I took a couple of my clients' financial statements, kind of melded them together, and put them up and highlighted the changes going on in the financial statements so that you guys can see what's new. This is what you guys have probably heard of a little bit, and this is the first thing that it's mentioned. When you have finally gotten used to the terminology, finally, and by the way, this terminology came in 1993, so you do the math, 25 years, something like that. We finally got used to hearing unrestricted, temporary restricted, permanently restricted, net assets contributions, right? We're not sure we understand always the difference between the temporary and the permanent, but we're not used to the term, right? We've argued with the boards, and the boards have tried to figure out, but we heard it. Now that you're used to it, forget it. It's gone. No more. No more temporary restricted, no more permanently restricted, no more unrestricted. This is what I say, accountants just sit around and create things. So what did they create? They took the three categories and collapsed it into two categories. The two categories now are going to be net assets with donor restriction, okay, and net assets without donor restriction. That's the result. Related to that will be contributions with donor restriction and contributions without donor restriction. So basically what has happened, let's synthesize that down. The unrestricted just became net assets without donor restriction. That's pretty straight. The real big change is taking temporarily restricted and permanently restricted and combining them into one category called net assets without donor restriction. And actually, guys, it is not correct. So please cross out. I see there's an error up here. Unrestricted should be without donor restriction. Please, if anybody was questioning that, they're absolutely right. Please change the slide on your handout slides. Net assets without donor restriction is unrestricted, and the two of them are now net assets with donor restriction. I apologize. I didn't catch that. Okay, so one more time, very important. Unrestricted is net assets without donor restriction. Without. Unrestricted, without donor restriction. The other two, temporary and permanent, are with donor restriction. Okay? Now, why did they change this? To make it simple on the statement of financial position. And those of you that don't know what the statement of financial position, you do know what the balance sheet is. Statement of financial position is the balance sheet. It's called that for not-for-profits. So instead of having on the statement of financial position 3 net assets, you now have 2. Why? Because they felt it was easier to read. We only have 2. Now, here's the kicker. Maybe it's just me, but they collapsed it, but still require you to break it out. Where do you break it out? You don't have to. You could do it on the statement of financial position, or you could do it in the notes. So maybe it's just me, but I see circular reasoning here. We went to collapse it to make it easier to read, but you now have to break it out somewhere else on it. they felt that it would be, and I'll tell you the other reason for it. So to be fair, some of you have heard about the Prudent Management Institutional Funds Act. New York has a version of it, NYMIFA, which told every institution that has endowments how they have to record and handle earnings from the endowment. What happened is that was in conflict with the gap for handling endowments. And that really talked about temporary and permanent and how you can use your earnings from it. So what they said is it's too confusing to follow that set of rules and then gap telling you it's this. So they collapsed it. But they still think you should break out these two sets of rules. When I say temporarily, what used to be temporarily restricted, a lot of you know, what does that mean? It means that something is restricted either for a purpose. I'm giving you a donor, I'm giving you $10,000 for your school program, for your museum, for your after-school training. That's restricted, and that's called temporary restricted. A permanent restriction, just so those that don't know, I figured you should have a good definition, is an endowment that really can't be touched. The corpus, the principal, cannot be touched. It maintained in perpetuity. You can use the earnings. That's a permanently restricted net assets. Temporary could be, as I said, for a program or for, and I gave you an example. It's for a program. It also could be a time restriction. For example, I promised to give you $10,000 a year for the next 3 years. We now have a time restriction, meaning that it's restricted for the next year and the year after. So the temporary used to be time restricted or purpose restricted, and the permanent was an endowment. We're collapsing those two. It's with donor restriction now. So let's take a look at what we ended up doing. We collapsed it, and you have an option. You could break it out, and I recommend, by the way, breaking it out, which means we went full circle, except you now have to break out even more than you did before. So if you notice on the bottom where your net assets, for those that deal with financial statements, you might recognize this. You have your assets minus your liability. It's what you're left over with at the end of the year. And you see under net assets you have without donor restriction, which used to be unrestricted, right? You'll see if on your handouts, you might not be able to see it up here, but there's two subcategories. Undesignated and designated by board for operating reserve. What that means is sometimes an organization has excess money, and the board says, why don't we bank some of this, put it away for the future, internally, or put it away for some program, or for construction, or for whatever we want. And internally, we could designate it. But the rules say only an external body can really restrict. So if you restrict it internally, it falls under without donor restriction, or used to be unrestricted. So you have two subcategories. The undesignated means there's absolutely no restriction internally. That's the first group. Okay, that's without donor restriction. With donor restriction is, I broke out three subcategories. Purpose restriction, as I said earlier in my example. This is what's left over that's restricted for a particular program or purpose. There is time restriction, meaning you can basically use it over several years. You're not entitled to it until the future. That's a time restriction. And then perpetual in nature is an endowment, which means, and a lot of wealthy people do it, I call it the gift that keeps on giving. Because I don't want to just give you money and that's it. I will give you $100,000. You invest it, and invest it, prudently, and the earnings on it can either be used restrictively or unrestrictively. And that's a permanent endowment. And that can't be touched. Now we're going to talk about the new rules on permanent endowments. That has changed. And that does follow the Prudent Management Institutional Funds Act. So we're going to talk about that in a couple of minutes. 1 second. If you do not put the information here, the option is you could have it without donor restriction, with donor restriction, and then in the notes break it out like that. I like doing it here, and I do that for my clients, but if you don't want to do it, you can. Now, as a general rule, guys, I will try to answer your questions. I don't want you to hold it to the end, but if it's too involved, I will say to you, talk to me after. Yes, sir.
Conceptually, it's clear why the 3 categories, and just in terms of requirement or ask, what's the philosophy behind it when it's already captured as a net asset, donor restricted? Why the breakout?
Well, first you said 3 categories. There are now 2.
Well, I'm talking about with donor.
Oh, with donor restriction, the 3 subcategories?
Yes.
And your question again, repeat it?
Yeah, conceptually I get it, but why not just leave it combined?
Why not just say with donor restriction? Well, if you're reading the financial statement, let's say it's $1 million.
Right.
Okay? Wouldn't you want to know what the restriction is as the reader? I mean, let's say you're going to be a donor, and you're the reading, and I say, I want to see if this organization is healthy. And donors are becoming very sophisticated now. Let me look at it. Oh, it's donor with donor restriction. What's the restriction? Is it permanent? Because they can't use that money if it's permanent. So the justifiable reason is to break out those categories so you know that one is just for the future. One has a purpose restriction, which, by the way, we're going to even give more details about the purpose. If you have purpose, you have to say what the purpose. If I have 5 programs, you have to do in the financial statement now what the major programs that the money's restricted. So the reader knows it's restricted for those programs. What it basically is giving the reader much more information than just giving them a lump sum. And you could say that about anything on the financial statement, by the way. And I don't mean to be facetious, but just to take what you said a step further. When you say I have assets of $400,000, you could say I have 2 assets, I have cash and everything else. You want to know detail. The more detail you have on there without going crazy is more informative to the reader, and that's the reason for it. Okay. Now that's the statement of financial position, otherwise known as the balance sheet. We also have the statement of activities, which in a commercial business is known as the profit and loss statement. Income statement. These are all terms. We use different terms for not-for-profit because we use different categories in not-for-profit. So the statement activities, the profit and loss statement, you might recall, and it's, by the way, there's different ways of formatting. My firm has done it one way. You could do it with columns. You could do it vertically, where it's one above. There's a lot of different ways. With the new rules, I'm going to suggest that this is more practical. So I have the old rules we said, unrestricted, temporary restricted, and permanently restricted, that you guys finally got used to and you can throw in the garbage now. And the new rule, without donor restriction, with donor restriction. Now here's an example of a statement that breaks up in the columns without donor restriction, as you can see on the top, with donor restriction, okay? And that's for the current year. This is comparative financial statements. So that's the current year. And if at all possible, if they're comparable, unless you're changing rules, which we are, you put 2 years, because it makes it much more informative to the reader to see a little historical comparison, last year, this year. Now, I don't know if I have this on a later slide, but it's a good time to mention it. When we switch over to the new rules, I'm going to suggest to you guys that you don't do comparative. There are rules to how to go back and restructure the prior year. But since the new rules are going to be so different, with my clients, and I suggest to you, you have last year's audit or review or compilation. You can have that on the side, but don't put them next to each other because it's a whole new ball game here. Now some of your auditing firms might have a different opinion. And I can tell you something, this stuff is so new that a lot of auditing firms are not exactly sure how they're handling it. I belong to a couple of committees, and I can tell you, most people talking about the new rules are saying, well, wait for the big four to come out and see what they want to do, and then we'll decide. And that's usually what drives a lot of the practical accounting examples. But you're going to see some variation. Again, this is my opinion. It doesn't mean that what they're saying is wrong, so I'm just making that suggestion. I think you should not try to do comparatives. Okay, so you see the two columns. Without donor restriction, with donor restriction. It used to be unrestricted, and the other column was temporary and permanent combined. And that's the column. And you notice somewhere in the middle of the slide, you have net assets released from restriction. Now what that is year one, money is restricted for a purpose or for a period, time period. And year two, you met the purpose restriction, or it is the time period to be used, and it must be reclassified. And so that's what that number is. And now the new rules say, which the old rules suggested, not everybody did, that you now have to do the release in detail. So if you're released for time restriction, or you're released for a program restriction, you must list it that way. You don't have to say every project. That's why it's satisfaction of program restriction, expiration of time restriction. In the past, it used to be said release from restricted assets. You now have to break that up. And in the past, it was a good idea, yes.
But also, if you, like in our agency, we may get $300,000 on a 3-year grant up front. So we'd have, and it would look good, great for cash, but that money is year 1, year 2, year 3, so that would apply here.
Absolutely. What you're speaking about is somebody's giving you, either giving you or promising you. By the way, if they promise, it's the same thing. So if you get the money, a 3-year commitment, a promise, and you said 3 years, let's say it's $300,000, for example, $100,000. The first year is without donor restriction, and the $200,000 would be with donor restriction, and the next year you would release it because you met the time restriction, and the year after you would release that. Exactly, yes?
What if it comes with both a time restriction and a program restriction?
That's a very good question. What do you do? What do you think? And if you're not sure, a lot of people are wondering. No, I think there is a prioritization. So to me, and I think you need clarification. That's a reason I was saying, what do you think? Because these are one of the things that are very convoluted when the donor says that. I mean, I'll give you a great example, and I'll answer you a second, because I love mentioning this. So I had an organization that a donor said, I know you need money. I promise you $10,000 for that program that you need money for, that sub-program. Okay? So it's restricted. However, if you need it for anything else, you can use it. However, please ask me first. If I'm out of the country, use your best judgment. You tell me which one you're going to use. I didn't make that up, I swear. The best part of reality is this stuff really happens, and on a daily basis, a weekly. So what you're asking is a very common kind of question. If there's a purpose restriction and a time restriction, I think what you should do, and this rule applies to everything in accounting, by the way. It's a fundamental, for those that remember a million years ago taking Accounting 101 and learning about core principles. It's conservatism principle. And conservatism says not that you hoard your money or not that you have a political affiliation, but what it says is that basically you take the approach that's the least effective on your financial statement. So if it's a purpose restriction and a time restriction, I would say I would err on the purpose, because the purpose is if it's not happening for 3 years, it doesn't make a difference. I said it could do to you said you're going to do it next year. You didn't do it next year. So that would be the most conservative. Okay? If it was a time that was 5 years, and I'm giving you for a purpose of the program that you're doing next year, and you're kind of doing it sort of, I would take the 5 years. So my answer is it depends. Unfortunately, you're going to hear me answer that on a lot of things. It depends. There's no, and you guys know this, there's no straightforward answer to a lot of these things. there is some degree of subjectivity. Okay. You see on the top, I couldn't have sound effects on my, well, I could, but I couldn't figure it out. Boom, boom, boom. When I read this FASB, which was the 21614, and I got to the page that talked about liquidity, okay, both quantitative and qualitative, I read that again, and I read it a third time. And I started discussing it with people. And basically, I'll summarize my reaction. Oh, they're going to love this. The new rules state that the organization must disclose how much liquid resources, liquidity, and they use financial assets as the determining factor, is available for general operating expenditures. They want to know what's available, and that's the quantitative. And the qualitative is what resources do you have to supplement that. And the first thing that comes to mind is a bank loan or a very wealthy board member that says, I can give you money. These are resources. This information that wasn't available in the past now has to go right in the footnotes. And when I saw that, I really smacked my head. Why did I get so bothered by this? Because, and you guys know this intimately, because the majority of not-for-profits are cash poor. Survive in spite of their cash position. This is not my knowledge or statistic. This is a given statistic. Anybody that services the not-for-profit world knows this, and you guys that are in it know this. You always juggling. A great example of this is you keep getting more and more grants. You should be doing great, right? But they're expense reimbursement grants, which means you have to lay out the money before you get it. And we know that the government officials, the government agencies, don't pay timely. Just saying. So here you are laying out money and waiting months, 6 months. I have some clients, they're waiting a year, 2 years. And what happened with the federal government also affected. But the state and city are terrible. They don't pay out. So what happens, you look like you're doing good from a bookkeeping, but cash, this is going to bring it to light. When you get to the page and the notes and see this, it's going to be hitting you. And then when the board members or the audit committee or you guys, this chief financial officer or the ED, sees this note and goes, I don't want everybody to know we can't afford paying our bills for the next, no more than 2 months. Do we have to have that disclosure? I expect this to be the single biggest question asked of me. Do we have to have that disclosure? And clearly, this is not subjective. There is a little subjectivity in here, and I love this one. But for the most part, you have to put this. So by the way, I gave a seminar, and at the seminar was a guy from FASB who was talking about all the new rules. And I said to Rick, but what about accounts payable? A lot of organizations are not paying their bills, and they use that money. Doesn't that go into the calculation here? And his answer was, you could get that on the statement of financial position. You don't need to have it here. So I think there's a piece missing. But here's what's going to happen. What's going to happen is when that note comes and that number is very low or negative, people are going to start, when I say people, the organization, are going to say, how do we change that? And a big piece of wanting to change is that anytime a board's going to restrict money. Unless the organization is cash rich, if a board restricts money and they don't have money at the end, that's the first thing that's going to be, we changed our mind. We don't mean really to restrict it. And so you're going to have to get a board resolution and show that to the auditor. But this is, to me, the big kahuna. And everything in here is a lot of extra work, but this one, again, is going to really affect a lot of organization, because you don't want prospective donors to see that you don't have money to operate, and yet that's a fact of life. You're constantly juggling. It's a fact of life. So What do you have to disclose? Well, let's talk about some of the rules. Now, I want you to make a real note in your head of something I highlighted over there. You can read quantitative and qualitative, okay, to meet its cash needs for general expenditures. Now, if we had nothing else to do and want to have fun here, I would have an exercise and said, you guys, I want you to define general expenditures to me. Because we'd be sitting here for 2 hours, and it would be a very, very interesting conversation. Now, I've been doing this a long time. You can tell by my gray hair, a long time. Now, it used to be dark hair. I've been counting 40 years and doing not-for-profits for 30 years. And I wasn't sure what that meant. So I went and read the FASB again. Not because I'm masochistic, because I thought I missed it. I could not find a definition, because that's the key for general expenditures. How do you define it? It wasn't in there. It wasn't in there. So we're going to talk about that. So let's start off. What is a financial asset? Okay? And what is a restriction? Okay? Let's talk about a restriction. Available for normal operations from general expenditures. If it's restricted, it's probably not available, right? And what is it could be restricted? It could be restricted by a contract that says you can't touch it. If you have a bank account that has a compensating balance that says you have to maintain a certain amount in here in order to get a good interest rate, so that you can't touch that. There's some leases that say you have to maintain money in escrow, and I can go on and on and on. So that by contract law, donors say it's restricted. Internal restricted, the board says you can't touch this money. So keep that in mind. It's not just donor restricted, it could be internal restriction, which is why I think that's going to change when you see the number. What's a financial asset? Financial asset is something that's cash, that's the most liquid, or can be converted to cash relatively easily or soon. So that would be definitely a short-term investment, money market, mutual funds, some mutual funds, a bond that's coming due, not long-term, not stock, okay? Also receivables, short-term receivables. If you're not going to get paid for 3 years, it doesn't fit into your financial assets. So it says, take your financial assets, everything, pull out what's restricted, internally and externally. What do you have left? That's what I have for general operations, all right? And general expenditures. So here's a very simple explanation. Total financial assets. I put a 2309 and 2380, 340, over 2 million on one line. Now, I didn't want to convolute this slide, but you can also put with financial assets, you can list them, which is what I will do with my clients. I will have cash, accounts receivable, short term. I will have investments available, total financial assets. I want the reader to know this, because if you just see total financial assets, how many of you, first of all, would know that? Maybe a lot of you. But how many other readers are going to know what a financial asset is? So you're going to get a call or an email. What is a financial asset? So I want to list them. And then, but for brevity purposes, I just did a total. So total financial assets, less restricted by donors with a purpose, restricted by donors for time, restricted because it's in an endowment, it's permanent, you can't touch it. All right? If the board said we're putting money away, you can't touch it, that would be a restriction here for this purpose and this purpose only. All right? You'd pull that out. The bottom is financial assets available to meet cash needs for general expenditures within 1 year. Yes?
Well, if you have cash that has to be left at a minimum balance for a loan or some other purpose, do you take that out as part of the less, or do you take that out on top before you get to the total financial assets?
I would, well, if it's cash, use your example. So you have cash that's restricted.
Okay, but that's a different line than those three. So you'd have something else like a.
Well, not really, because what asset is it?
It's just If it's cash restricted by loan covenant.
Okay, well that's cash restricted. It would be in your total assets. And then when it says, I would have another line there, what I would do, restricted by loan covenant. I would identify. Now, if you have 3 or 4 of them, different leases or something, I would combine them. I wouldn't go crazy. I know a lot of CPAs that just list everything. But I would total the groupings, and that would be pulled out. It's exactly what, I mean, there's a couple other categories I didn't put there. So yeah, anything that would be there. And then you come to what's available. Now, I want to just see this. I'll come to that in a second. So that is the quantitative. What's the qualitative? The qualitative is what other resources do you have availability of? Okay? And you must provide what do you have availability and how do you use it? A classic example of this would be a bank credit line. Okay? The bank, we have a credit line which we either use or we don't use. By the way, for those that, I go off in tangents, so bear with me. For those of you that your organization actually does have extra money, which is rare, but if you're in the minority, I have been recommending this for the last 5 years, and I always get a lot of pushback. It's off topic here, but it's a good bit of advice. If you have money, that's the time to go to the bank and get a credit line. And that's exactly the time I get told, why do we need a credit line? We have $1 million and an investment. And the answer some of you can probably come up with is because when you need it, the bank is not going to give it to you because they want to see that you are flush. Banks only give money to those that don't need it, in case you didn't realize that, and they look at your portfolio. So I had a couple of clients a number of years ago, and they actually took my, of course they go and say, well, is there a cost to this? Yes. Because most banks, unless you have a lot of money there and doing a lot of transaction, charge you a percentage to have a credit line. Typically, it can vary, but 1% is not crazy. So if you have 100,000, right, it's 1,000 for the year. And you can do 500 and you can do the math. Why do I want to spend $1,000 if I don't need it? Because when you need it, you're not going to be able to get it. So just off topic, but I think it's important. But it relates to this. So what is a qualitative? We have a credit line. Using my example, we have a credit line, a $500,000 credit line that we can draw down on. That becomes a qualitative, and as part of the note, you'll see, and I'll read it. As part of our liquidity management plan, the organization has a $250,000 credit line with a financial institution that matures on May 4th, 2000 X5, with a major financial institution, blah, 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 they can draw down on. As of this year, the organization has not drawn down. To let the reader know you have access to that. Very, very informative. Now, what are the problems here, if you haven't realized, and I said it earlier. If you don't have money, and you're really hoping to get more loans, going to apply for grants, hoping your next fundraiser, your special event is going to be very successful, and you're going to get sponsors, you're using that optimism to plan how I'm going to survive next year. But that doesn't translate to numbers, cold, hard numbers. So when the numbers are not showing up, you as the ED, the president, the board member, the treasurer, and anybody else that's talking and reading this is going to go, this is going to scare the, you fill in the next word. I have to tame myself. But you can fill in that word. It's going to scare the heck out of everybody. And that's going to be a big problem. Now, here's what I see as a problem. When I say I'm giving you money restricted, let's use a school program, and they have expanding an existing program, and they want to have more kids, and they want to do some kind of tutoring, whatever. And a donor says, I will give you $20,000 to expand that program. You can ask yourself, is that restricted? Is that for, going back to the slide, general expenditures? It's restricted for the program. It's not for general expenditures. And that's singly what I have a problem. But that's what your program is. So isn't your general expenditures to pay for your programs? I had a problem with that exact statement. What is general expenditures? And so again, I was able to ask the guy who was presenting this from FASB, and I asked him, there's no definition of general expenditures. And this is what I love. With all these new rules, the answer given, you define it. We took all the old rules and pulled out subjectivity, and we now put in a major subjective area that you define what's general expenditures. So, I will be taking, and I told my staff, a very liberal approach to this, because I know what the end result is, but I will define it very clearly. Basically, if it's an existing program, and again, I'm prefacing by saying this is subjective. This is my opinion. It's not Godspell. If it's an existing program you have that you've been running, whether you're expanding it or not, it's part of your general expenditures. They don't mean, by the way, in general expenditures, they do not mean management in general. Be clear of that. They mean general expenditures, which you normally spend to operate. So I will define that as things you normally do, and I will define that in the notes. But be careful. I mean, that's my interpretation, and until I get some kind of pushback, which I don't think I will, that's the way I'm going. You guys can, wrestle with your preparers on that. But I think that's going to be a big issue. So here's an example. Oh, just one second, Karen. Here's one example. It is management's policy to include donations restricted for next year or next year's existing programs and financial assets available to meet cash needs for general expenditure. You see there, it's management's policy to include donations restricted for next year or next year's existing programs. So I'm telling you the money's restricted for next year. It's for your normal operating next year. And if it's for a program that's existing, it's also general. That's just my suggestion. Yes, Karen?
So you focus on talking about what is general. Give me an example of what's not, what would not be considered general expenditure.
I am donating $1 million for you to renovate your building.
Or an event.
I'm giving you, yes, I'm giving you money for your event. There goes a gray area again. Is this an event that I normally, and I think you can define it any which way. I could define that since I've had this event, this fundraising event every year, special event, a gala every year, that you're donating money for that. And since it's next year, it's probably not going to be an issue because people don't generally donate for galas going out 3-4 years. But if that was the case, I might and might not put it. It's going to be a case-by-case basis. Very big issue, guys. I can't minimize it. Okay, that's all I could. There's a lot more on that area, but again, for lack of time, I'm gonna stop at that point. Okay, let's talk about something that is unique to not-for-profits, and I got to go back a little bit. Before I talk about the statement that you guys know is the statement of functional expenses, which, by the way, you can take that term, and wherever the garbage is, pop it in there, because it's another one that's going. Go back to the statement of activities. The statement activities is a functional statement. What I mean by that is you list expenses by program and supporting services. Totals, as you'll see down below here. The detail of what goes into those expenses gets broken out onto another schedule that we know as the statement of functional expenses. So this is a functional, kind of a functional statement here, but not detailed. So when we go over to the statement of functional expenses, here was the old rule, the old FASB rule that fell under Statement of Financial Accounting Standards, SFAS 116. It said that only voluntary health and welfare organizations are required to do this statement of functional expenses. All other organizations are not required, which means membership and civic and all the other ones. If you're not a voluntary health or welfare, you did not have to do this statement. Now, I think every organization should have prepared this, and for 30 years we've been preparing it in our firm. Some preparers said, I don't have to do it, I'm not doing it, and they didn't put this. But that statement was, again, only required if you were voluntary health and welfare. The new rule says, I feel like, who used to do new rules? Bill Maher? New rules, I guess I can steal it from him. New rules is every organization now has to do this two-dimensional, for lack of a better word, two-dimensional financial statement that lists by function and by what's called natural classification. Function being program, our major programs, not every project, program 1, 2, 3, and supporting services, management in general, fundraising. By the way, there's another one that no one ever does. It's in the old, it was called membership. It was considered a supporting service. Nobody has ever broken that out. They mix it in with management. But supporting services and program was you did it by that dimension, and then the detail by expenses that we all know. Salary, rent, telephone, so forth. So this statement, which you can't read up here, is two-dimensional, by column, by function, and along the side by natural classification. Now every single organization, which I thought should have always been the case, has to do this. So you now, by the way, need 4 statements. Statement of financial position, balance sheet. Statement of activities or profit and loss statement, call it whatever. Statement of cash flow that nobody understands. Nobody. Accountants, readers, nobody understands that one. You'll see that I don't cover that. 30 years I've been presenting financial statements to boards, and I've gotten 2 questions. I usually say, do you guys want me to cover this? No, I don't really want. 2 questions I got in 30 years. Who do you think these people are? They're bankers. Well, they do statement of cash flows. They understand liquidity and ratios and current ratios. They get it. Nobody else understands it. So I just say, you want me to skip? And we skip. So we won't cover that, thankfully. But so that's a statement. What am I up to? 3. And the statement, what used to be the statement of functional expenses, which are not, can't use the old name anymore because we're doing everything new. So what are we going to call it? Guess what? In that second reading, I was looking for it. They didn't come up with a name. They did not come up with a name. As a matter of fact, what I love about this is they said this will probably be in the notes. Now, you guys, if not every one of you, almost everyone works on Excel. Could you imagine getting that on a Word document? I mean, you can highlight Excel and cut and paste, but then try to, adjust the columns, They said, these are accountants, they said you'll be in the notes. But if you don't want it in the notes, you have to do it as a separate statement. Now, by some of you, by the way, have had it in the past as statements, okay? It's a landscape. But also you've had it either as a statement or a schedule, because the old rules said it wasn't a statement. So if you put it behind the opinion and all the way back, it was a schedule. You can't do it as a schedule anymore. That is a change too. If you do it as a separate report, I don't want to call it a statement, but if you do it as a separate report, it is a statement. And then it becomes part of the 4 statements you have. And you will have 4 statements. Now, quite frankly, anybody else that doesn't have 4 statements and wants to do this, please send it to me. I'd love to see it. Because I think it's going to, especially one that has a lot of programs. In any case, you will have 4 statements. Statement of financial position, statement of activities, statement of cash flows, and statement of, what are we calling it? The second time I read, to try to find out with general expenditures, I was also reading, what do we call this statement? Left it out. So in a committee with a lot of other professionals that specialize in not-for-profit, I raised that question. Hey guys, what are we going to call this? I guess we could call it statement of functional expenses, but it's not just by function. It's by function and natural classification. So when I said it's by both, well, why don't we call it both? So here's my 2 options for you. And I think both are equally valid. You could call it, which I'm leaning towards this way. We've already started doing it. Statement of expenses by function and natural classification, because that's exactly what it is. And if you want to summarize it, you probably could just call it statement of expenses. I think either one is valid. Yes, Ted.
A lot of what we do is to get our statements in line with what goes on in the 990 sections that report expenses and such. Is there any guidance there that may allow us to go with, say, statement of expenses instead? You know, because we sort of try to make them consistent, particularly before board members who have no idea what we're thinking
Right.
anyway, right?
Well, my answer to you is, it might not really answer, but actually I think you're putting the, if I'm doing this right, the horse before the cart. You don't do the financials to match the 990. The 990, when it got revised, was to match the financial statements. And so the financial statements really, the 990 does match it. Sometimes they want some breakout that you don't have on there. If you're talking about like professional fees, on the 990 it breaks out 3 or 4 of them. But I don't think it's a problem, because I think if you do the financial statement correctly, you'll be able to segue that to the 990, plus go to the general ledger and get other things. I don't think that's going to be a problem. But it's funny, not funny, but you raised something that you guys are going to realize when you look at the 990. So I said they collapsed the name from unrestricted, temporary restricted, permanently into with donor restriction, without donor restriction. You know how long it takes the IRS to change a form? So guess what? The IRS 990 doesn't have those 2 buckets. They have the old buckets. So if you read the instructions, they basically said you could put it in either box. And out of the 2, I would recommend sticking it in temporary. And then on Schedule O, which is a notepad in the back, I would then break it out on the 990. That's my suggestion. That's what I'm going to be doing. But that's just another point. Yes? Hi.
I am wondering if they have also instated some more solid guidelines for how you come up with these classifications in the first place, if there are, in terms of management in general, but like how much overhead can you count towards program, all of those kind of things that nonprofits have somehow magically showed that they use 99% of their income for program expenses. Are there any crackdowns on those classifications that hit us?
And actually, there are. And it's actually in the 216.14 update. It actually talked about, and we're going to actually get to it, you now have to disclose, I'm jumping again, but you have to disclose how you allocate. And that is the rule, and they did put it down. So they don't tell you exactly how to do it, because there is no way to do it. I mean, I have some organizations that really, all the people working are working on the program, and that's who's running the organization, which is what comes up all the time. How could everybody be working on the program? Did the organization just happen? In some very rare cases, that does exist. It's in the cloud, and there isn't. But most of the time, there is. So it leaves a lot of leeway for you to decide, but you now have to disclose it. You cannot. The old rules, by the way, were there too. You were supposed to use reasonable, rational, consistent. As anybody, as auditor said, we have to allocate this. And of course, everybody wants to push everything to programs, and there's the battle that goes on. So, but now you have to disclose it, and we're gonna come to it. So in any case, now call it either name you want: statement expenses, statement of expenses by function and natural classification. And as a matter of fact, I thought it was the next slide. I should have just gone down a little further. Here's the disclosure on the bottom. A disclosure is now required to explain how you allocate it. Maybe that's what triggered you to ask. So here is a sample. Again, it doesn't mean that's the only way to disclose it. The financial statements report contains certain categories of expenses that are attributed to more than one program and supporting function. Therefore, expenses have to be allocated. The expenses that are allocated include salary and related expenses. Okay? which are allocated on a base. Now here is the gray area. Here's the gray area. What is it based on? We know what it's based on in reality. We know. I'm not going to expound on that, but we know. And for the most part, if you're reasonable, rational, and consistent, and say the ED spends probably 10, 20% of their time running around trying to raise money, and just supervising, probably another 30, and 50% actually doing the program. They are a certified therapists. They actually see clients or patients. So this program, you could probably use that ballpark. But unless you have time cards, which unless you're in the union or doing something, or time sheets, there's no way to do this. So you have to use a rational basis. Now, if you get federal money, they require a little bit more than that. So we'll leave out federal money here. But in this case, I actually said allocated on the basis of estimates of time and effort. And that's a very generic kind of statement, but isn't that what we're doing? Hey, guys, how much time is your ED spending? What I just said, you're telling me that's based on time. It's an estimate, okay? And like I said, I've been doing this a long time. Except for federal money, I have never had a problem of supporting this, being rational and reasonable. Yes?
We do our statement of functional expenses at the end of the year, so it's a once-a-year exercise. Is that a correct approach, or should we be incorporating this into our monthly?
Well, not to be facetious, but if it's not correct, then 90% of my clients aren't, 95, 98% aren't doing it right. So what I'm saying is that would it be better to do it on a regular basis, assuming you guys had nothing better to do but to work on that? And don't throw anything at me, because that usually gets people up in arms. You can't. You can't. And for the most, unless you're doing budgets and submitting, and doing variance reports between budget and actual, where you really do have to allocate it on either a monthly basis or quarterly basis, you do it at year end when you have to do it for the reporting. Now, I qualify that if you have to do periodic reports, then you have to do it, because your reports are on a more periodic basis and you need variance. That's a whole other topic. I've given lectures, and those that have taken my course at Baruch, when I cover budgets for a whole class, know my approach on monthly budgets, which some of you have done, is an exercise in insanity, because you're always explaining why there's a timing difference. So I'll throw that out, as things come to me in lecturing, that if you want to do periodic, unless of course it's mandated by a grantor or government agency, it's probably, if you need more frequently, quarterly is pretty good. It gives enough flexibility to not wait the year end, and better than annual. But monthly, unless you have the big staff and you're really on top of it, it's never going to be accurate. But that's, again, another subject. But if you have to, you do it. So if you have to, you do it. If you don't, you do it year end. Okay. So there's my statement of expenses by function and natural classification. Natural classification is exactly the same as the statement of functional expenses before. No different, just a different name. Okay. Some other changes in this 216.14. Underwater endowments, and I'll explain what that is. Reporting net investment expenses, and I'll tell you what that is. And reporting donations for construction of long-lived assets, which would be a building or a renovation of a building. Okay. So what's the old rule in underwater endowments? I will summarize it. You can read this later. An underwater endowment, especially under the old general accepted accounting principle, was as follows. Somebody gives $1 million and said, you can invest it and you can use the earnings to do X, Y, and Z. So the endowment itself, the $1 million, is permanent in perpetuity. You can't touch it. And the earnings from year to year, you pull out and use it for the program. If the endowment went down in value, and anybody that remembers not long ago, 2008 and 2009, knows that organizations that had big endowments all of a sudden had their endowment going down. Now, the accounting rules say we must maintain our books on the cost basis. That is the U.S. underpinning accounting rule. Fundamental. We do it on the cost basis, with the exception of investments that are regularly traded and have a objective value. Everything else has to be on the cost basis. Okay, unlike international rules, which do it on the fair market value. So every year, the organization, if it has an endowment or investments, either or, and usually they're related, because if you have an endowment, it's invested, you must adjust your books for the fair value. If your portfolio goes up, and I had $1 million, and it was a great year, and all my investments went up 10%, at the end of the year, I have, assuming I didn't spend it, I have $1.1 million. And you book that 100,000 as unrealized gain. Okay? That was never a problem. When we get money, it's never a problem. It's when it's the other way that's a problem. That $1 million investment after 2008 is now 700 and something. And I believe that number was pretty close to a couple of my clients that had $1 million. Now, under the old accounting rules, under FASB 116, you had to maintain that investment at the value you got it. You didn't adjust, although you adjust your investment, which you have to maintain the endowment at the principal. So again, you would book it. So what are you doing with the unrealized loss? The 200 and something thousand I just said. Well, if the permanent restricted has to be permanent, right, what do you do with it? So you would have to use money from unrestricted sources to make sure that endowment was the $1 million. And for most organizations that didn't have investment over that and didn't have cash, what are they going to do? So they're now violating the covenant with the donor. And now they're in violation. That was the old accounting rules. And the Prudent Investment Act changed that, and now the accounting rules mirrored that Uniform Prudent Investment Funds Act, and now said you no longer have to maintain the principle of the endowment. It can go up and down as long as, this is the key thing, they put the word imprudent in that word, as long as you're prudent. Meaning, if it went down, you can't take like you used to take. 10%, it was $1 million, I could take out 100,000. It goes down to 700, I still take out 100,000, that's not prudent. But you can still take out even if it goes down. You didn't have to use unrestricted or without donor restriction to make it up. So they changed that rule in this FASB. So the example I gave you up there, that New York, every state passed a version of the Uniform Prudent Funds Act, and NIUP MIFR is the New York version, New York Uniform Prudent Management of Institutional Fund Act. 48 states has it, DC and the U.S. Virgin Islands. There's 2 states that don't have it. I can't remember who it is. I think Hawaii might be one of them, but we don't care. So that makes a big difference for a lot of organizations. That was a good change. Okay. But now you have to disclose your policy. Yes?
Just to go back to what you were saying, if you have an endowment and you earn, say, $10,000 on a $150,000 endowment that's permanent, and you can use the income, and you take it at the end of the year, it's December, and you earn $10,000, so you take it in January or February, and then let's say next year it goes down to 85, but you earned 4,000. So you could take the 4, even though you're below?
You can take the 4 under the new rules, but you just have to disclose what your
Disclose what it is, yeah.
Well, you disclose your policy, and what I'm just going to get to is you have to disclose certain things. If it's underwater, and only if it's underwater, you have to disclose what your appropriations are during the year. We took it out. Okay, the fair value of the funds, so now it's 700 or instead of $1 million. The original gift, $1 million, using my example, and the amount that's underwater, which is the subtraction, okay? And the key thing is that note in there, which says that from time to time, the endowment may have a fair value less than the amount required. And you can read the rest of it, it's what I told you. Okay, just a couple of more things, and we're going to get on to, anybody have, I'll stop here for a quick question. Anybody have any issues with this, with the endowment? They pretty much understand. It's actually a better requirement. Okay, a couple other things in the 2/16/14 financial statement update. It was pretty voluminous. Some of them are good, believe it or not. Some actually made it easy for us. The next one I think is easier. You no longer have to break out components of your gains and losses and investment changes to the level you used to do it before. You now can report investment income net. And so basically, what we used to do, we used to have in the notes, unrealized gains and losses, realized gains and losses, interest and dividend, and investment expense. Now, with the exception of brokers who work for an investment house, I ask you guys if you can easily find out what the investment expenses in from the broker statement. Because I'm going to tell you, not so easy to see. It might be if it's a management fee, because that's a fee. But many brokers charge money on a lot of different ways. It could be a management fee, it could be on a trading fee, it could be on the asset value fee. There's a lot of them. And I'm going to tell you, most statements it's buried. So it was a requirement to break it out, but you can't get the information. And of course you call the broker and say, what's the expense, meaning what's your take on it? And they're going to be real quick to want to tell you what they took. I mean, but you're required to break it out. And if you don't know it, you can't disclose. That rule's bye-bye. You now do an investment based on net. If you want to break it out, you can, and that's optional if you want to break out. But the expenses, definitely you don't have to worry about it anymore. Okay, that's one change. Next one on here is the first one, which I skipped over. And by the way, this was an old rule. It's just that people weren't following it. Remember we were talking about restricted money? Somebody mentioned restricted money. Before you had it in with your cash, you might not have disclosed it. You really should have. If cash is restricted, especially for long term, somebody donated money to do a renovation of your office or your building. It's $100,000. You had it in cash. It was misleading. You should have broken it out. You should have put it in long-term assets, down on the pecking order of the assets. Now it's not an option. If you have restricted money, it has to be broken out as cash dash restricted on the statement of financial position. So that's a change. The last one I'm going to skip over because a lot of people didn't. I'm not going to skip over. I'm just not going to delve into it. The old rule on somebody donates a building, and we don't have this often, where somebody donates a building. Somebody donates a building. The way it used to be recorded is recorded as temporarily restricted because I'm using it over whatever years, 30 years. And that as I'm using it, each year there's depreciation. We all know that. And as the depreciation came, we then released the asset from temporary restricted to unrestricted. Okay? That rule is gone. If somebody donates a building, and it's now being able to be used, okay, it could be occupied, it's not being constructed, you pick that up as without donor restriction, or what used to be temporarily restricted. So that's, again, it doesn't affect, that's why I'm not going to delve into it too much. Okay. That's it on the one FASB. We got two more to cover. This one is, I think, a great one. And I don't say that easily. This one about counting guidance for contributions received and contributions made. This came about because of the next update, which was revenue recognition. Because revenue recognition affected all organizations. Now, whether I pick something up as an exchange transaction, I'll explain that, affects what do I do with contributions. Now, this area, by the way, to me, is the single most confusing area to not-for-profits. If I had to take one area that affects more not-for-profits, especially public charities, they get contributions, it would be how to treat contributions and related government grants. Contributions, grants from foundation, government grants, the terminology is used kind of interchangeably. A lot of accountants were doing different things. Now, with the exception of only one thing, my firm has been doing the same thing for years and years. So it really didn't change, but I can tell you, and you guys will know better than me, whether your preparer was doing it differently. But a lot of accountants weren't doing this. I'll give you an example that's not up here. That when I took over another client, I was looking at a financial statement. They got a government grant that says that the grant is good for a calendar year. And their operating year was July to June. So it fell in the middle. And a lot of you guys have this situation where the operating year and the grant period are different. So what did they do? The government grant was, let's say, $100,000, and the accountant would say, well, half of it is in this year, half of it is in that year. So we'll book half of it in this year, and we'll book half in the year. They prorated it. That wasn't the old rules, and it's definitely not the new rules. There were rules about when you pick up a contribution and when you pick up a grant. The old rules. This clarified government grants, we'll get to it. It's a big clarification, but I'm making the point that this did not change the old rules. It just clarified it, with the exception, I think, of government grants. It changed something on that. And you guys know you wrestle with this all the time. I gave you an example earlier of a donor that said this, but you can do that, but you can do that. Many times a donor is very ambiguous, or it's not in writing. Now, you might not have heard this unless you were in my classes in the past, but where did it come up with the rule that you book donations immediately? I mean, it doesn't follow basic accounting rules. Basic accounting rules say if I give you money for the future, in any other transaction, it's really for the future. If you give me the money, it's deferred. I did not earn it. That's the accrual-based accounting. The accounting body said if anybody promises you or gives you money for any reason, you must book it in this year. And early on, years ago, I tried to find out why, and there was a couple of justifications for it, in case you're interested. One is, a lot of times there's no documentation to when this is supposed to be used. So a lot of organizations were playing around. Some would take it this year, some would take it next year, whenever they needed to, kind of balance their books. So there was a lot of ambiguity, and you can't compare two organizations. That was one reason. The second reason was, especially public charities, you live by donations. You make plans based on donations or promises. So it's very important that the reader knows that this money is either promised or you got it and what it's restricted. So the rules back in '93 said, we're going to make you book. Somebody promises and there's no, any condition, and we'll talk about a condition in a second, you book it in this year, but we'll let you separate it. We used to call it temporary, restricted, or permanently. Now it's with donor restriction, without donor restriction, but you book it in this year. And people new to the not-for-profit accounting world, usually when they see this go, huh? What? I got to book this year? And it's an eye-opener. And all you guys, the first time that you fell into not-for-profit, and since there's no training in this area, you all experienced this the first year you had to do books. Like, I have to do what with this? So that's what the old rules are, and that is the new rules, except with this update, they really, really clarified. No more playing around. We're going to define things, and you have to follow these rules, and there's very little ambiguity. Again, the donor might be ambiguous here, but you must follow. If it meets one test, you follow it. No more saying, well, it's expense reimbursement, I don't know if I'm getting the money, blah, blah, blah. So this clarified, again, with the government grants being slightly different. So let's just delve into it. We have a little time. As I just said, So it clears up confusion. What kind of confusion? Here are a couple of major ones. Does the donation have an exchange transaction? Okay, and I'm going to define that in a second. Is it a conditional contribution? I'll define that. Is it a restricted contribution? And if I had to tell you two words that are not synonymous, but so many people think are synonymous, it's conditional and restriction. I can't tell you a week or 2 weeks go by that I don't have a board member call me up and say, I need to understand this. So we got this money that's restricted for when we raise money, and they don't know what conditional and restricted means. And it makes a big difference, because if it's conditional, you treat it a certain way, and if it's restricted, you treat it a different way. And it can make the difference between your numbers looking good this year and not looking good this year. So it does have a big impact. What's an exchange transaction? It sounds more complicated. An exchange transaction means somebody is giving money and getting something back for it. Plain and simple. If I'm a great example, if I'm giving a not-for-profit that's a school, and I'm paying for tuition, I'm not making a donation. I'm getting back. I'm paying for something I'm getting. Okay? Clear case. That's an exchange transaction. One that's not so clear, but is an exchange transaction. I'm paying $500 for a ticket to your event. A lot of organizations treat it as $500 contribution, but the person getting something back. Well, let's leave out the valuation for a second. But it costs money for the drinks, for the food, and maybe the hall. Not maybe. Well, yeah, sometimes you get donated a hall. And that proration is what I'm getting. If I was to pay for it, it'd be worth $75. I'm giving $500, I'm getting back $75. That's an exchange transaction. And many transactions have both pieces, and it has to be bifurcated. So that's an exchange transaction. What is a condition? This update clearly defines what a condition is, so that you don't classify or misunderstand what a condition is. It says, and it must be a donor condition. If you do it internally, it doesn't meet this test. It's a donor stipulation, and I'm going to read it, that presents, and this is a new word. Accountants love to use new words. That represents a barrier. They really want to hit you on the head. It's a barrier. It's in front of you. You can't get over it. That must be overcome before the recipient is entitled to the assets transferred or promised. The agreement also must give either a contributor a right of return of the asset as transferred or the promisor, a right of release from the obligation to transfer the asset. Let me translate that for you. What that's saying is, in order to be a condition, there has to be this barrier, meaning something has to occur. Not a restriction. Something has to occur that hasn't occurred yet. And, very important, it did add this, that if you don't meet that condition, okay, in that agreement, that if they gave you the money, you have to give it back, or if they didn't give you the money, they have a right to take it back. If it doesn't specify those two things, both a right of return or actually you're excused from paying, and the condition, it's not conditional. And if it's not conditional, you book it. All right? And then what's a donor-imposed restriction? It means it's restricted for a program or for a time period, as I talked, or for the endowment, or for a building, which is, that's a restriction. I'm giving you money for the building. Some restriction externally imposed. Depending on what these are, it gets treated differently. It can make the difference of you having a great year or a terrible year. All right? Temporary, I told you, it could be either or and permanent. We're not going to use those terms. It's with donor and without donor restriction. And the last two go with donor restriction. Yes?
Somebody donates and gets a building named after them. Is that an exchange?
If somebody donates, say it again?
A building and gets it named after them. Is there an exchange? Is there an exchange?
That's a good question, Clayton. Because there's an intangible.
That gets his name on it?
No, I understand. It's an intangible benefit.
Even that intent?
Well, it is intangible because when they say intangible, it's an intangible. It's rights to it's recognition. I would take the position no. I don't think it's an exchange. You could argue it depending how prominent it is and how you're doing. But I'll give you a better
Could it be
one.
conditional if the guy says,
No, I don't believe it's conditional. The question is what's the condition?
The condition is I'm not going to give you the building.
If you don't name it after me? That's a condition, yeah. That's a condition. And by the way, guys, if you take money from a donor, unless it's for an illegal or unethical reason, you got to comply with those. I get asked every once in a while, the donor wants me to do blah, 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 and do a report upside down, inside out. Do I have to do it? Did you take the money? Is it illegal? Yeah, you have to do it. Now, if they're saying, I'll take the money, you have to name the building after me, and if you qualify that, assuming that I'm allowed to do it in the community and what, I would say that's conditional. But I got a better one that affects more of you, and I could be in a room with CPAs and we could all debate this. What about somebody that sponsors an event? You're going to get more than half of the auditors going on one side, and I used to be on the minority, and now I'm heading with the new rules back with the majority for one simple reason, and that has to do with conditional reason. But somebody sponsors an event, and what do they get? They get their name in the dinner dance and a journal. They get put on the screen. They promote it before the event. They get to use it in their publications. I mean, people do stuff for benevolent reasons, but business is business. And we all know that when people sponsor events, they want recognition, and it's good for business and it's good for the community. Is that an exchange transaction? Okay? I used to take the position, yes, because they wouldn't be doing it. And the rare number that says, I believe in this cause, this medical cause, I believe so-and-so, and my family had this illness. But I said you're getting something, and I used to take it as an exchange transaction, not a contribution, where most people didn't. Now, with the rules about valuing it and disclosing, I'm probably going to head towards the fact that it's not an exchange, it's more of a contribution for the reasons that we're going to talk about. Yes?
So on the donor side, with things like events, you will usually say something like, you can, if the ticket costs $500, but it costs the organization $150, you can write off the $350 that makes the difference, but not the total $500.
You're talking about deductibility for their own tax purposes?
That's how I would think of the exchange transaction.
Well, it does have that consequence. So if you have an exchange transaction, it's not a contribution, and therefore it's not a contribution deduction, okay? And so obviously that's the other reason sponsorships people want to put. But you know what? I tell people this all the time, and they go, oh, right. When they say, oh, no, I'm not talking about individuals now. Individuals, yeah, they want that. If you're a business, you're writing it off anyway. I mean, I'm being quoted here, so as long as the IRS doesn't get on Baruch's website, I'm okay. But I don't have a problem with that. Is it a legitimate business deduction? Not just a contribution deduction. So to me, they're deducting. Now, individuals, yes. Individuals, I gave you $500. I could have given it to another organization. My neighbor said, do this, I did it. How much can I deduct? And if they don't have a business, they can't have a business deductions. But it is an exchange.
Yeah, but could you similarly say on the organization side that 150 is the exchange and the rest of it is a contribution?
If that's a legitimate amount. I mean, you could say whatever you want, but you can't. You're supposed to pick some. And basically, what you do.
Arbitrary number.
Yeah, if you basically take, you know what your costs are. If you take your facility, you take your food, you take, if you have entertainment, you put it all together, your hard costs, and you say we're having 200 attendees, and you divide it, that's the cost. And you tell them, thank you for your deduction of so-and-so. Please be advised that this is an exchange. Now, this is not a tax seminar, but under the tax rule, you have to tell a donor if $75 they give and part of that is an exchange transaction, you must give them a notice. Where normally, if you just give a donation, the amount's $250. So just so you know, that's a disclosure requirement. Okay, so just clarifying this, again, contributions must be valued at the fair value at the time they're giving it. So if somebody, a great example of that is somebody says, I promise to give you $10,000 over the next 5 years, you do not book $50,000. Because we all remember some class we took somewhere that there's a time value of money and we have to present value that and bring it back so that 50,000 is 40,000 something. And that's what you must do when you book it. You must book it because we have to immediately recognize it, but it's at the fair value at the time right now. Now, if it's a conditional contribution, you do not book it, clearly. And a great example of a conditional is, look, I'm not just giving you money. You got to work for it. So I'll match you. And this is typical on a board member. I'll match you. You guys raise X dollars, and I'll give it to you. So you got to work for this. That's the condition. You do not book their 25 until you raise that money. Okay? That's a clear example of that. However, if it's a restricted contribution, you immediately book it as what used to be temporary or permanent, now with donor restriction for a time or purpose. Okay? And again, it doesn't, here's the problem. It does not follow the basic accounting rules, the core, which is something, I'll throw another thing from a million years ago, called the matching principle. You match revenue and expenses in the same year. That's why we have an accrual system in accounting. We don't use cash, we use accrual, we match. This violates the matching principle. You're giving me the money this year, and I'm going to put it as with donor restriction, which is what the accountant said, well, you'll separate it, but who separates it when they're reading it? We all know that you look at the bottom number, and the bottom number said this year I did great. And then you're left to explain it to people, well, yeah, but the money is for next year. And what happens next year? You reclassify it, but the next year, assuming all the numbers are the same, next year you have a terrible year because you didn't get it, you spent the money, so it violates the matching principle. But the accounting rules said we'll call it two different things, but we'll violate it. And that has why people have a lot of problems with this concept. That's the rules, but it is a little confusing. Now, government grants. This has been more than clarified. Well, it's been clarified, but by clarifying something has changed how you treat government grants. And I'll explain it to you, okay? It used to be the government gave you money, gave you a grant to do something. Is it an exchange transaction or is it like a contribution? If you read that agreement, which we do read, it has all kinds of weird provisions in there. We must do this, we must obtain this, you must give us a report periodically, you must show us what we must approve the report. So to me, is that a condition? Well, you have accountants on both sides of the aisle saying, if the government grant says that you have this money or we promise you the money, provided that when you submit the report, we approve it, which is very common, we must approve the report, that's a condition, isn't it? Conditional on approving. A lot of accountants that say, I'm not booking it, it's conditional. And it was an argument, okay? And then the question is, that's one issue, and then the question is, the government is giving us money to do a research project. Is it an exchange transaction? We must do the research project. Or are they giving us a contribution? And you have some accountants treat it one way and some will treat it the other way. This clarified it, and this was one of the major changes. And this is what the FASB said. And I happen to think this was really good. They said, even though the government is giving you money, who is the ultimate beneficiary of that money? Is it the government or is it the public at large? And is the government just an agent paying the money, with our taxes of course, but paying the money and they're not really getting the benefit? or are they getting the benefit? And you must ask yourself that. So that's a very important point. Related to that is what I just said. The fact that they said you must submit a report at the end, we must approve it. Is that really part of the restriction or condition? Or is it just an administrative requirement? And a lot of them say if your report does not meet our standards, you got to give the money back. This FASB clarified it, and will change around how we treat. What did it say? The last line here. Most of the time, the money the government is giving is not for the government. It's for the public. They're giving you a grant to do something. Therefore, the parties to the transaction are really the public and basically the not-for-profit and not the government. And so now you say, oh, who are the two parties? Is this an exchange transaction? And what it's going to do, it's going to tilt more of these transactions to be contributions than being an exchange transaction. That's the bottom line, yes.
What if the government says you have to see 40 to 60 clients a quarter? And when you voucher out, you'll base it on that, and then they do impact surveys and stuff like that. So then that would change it a little bit?
I think so. I think in that case that you're clearly saying that it's restricted for this, but clearly saying that you must meet this or you don't. Now, it has to be more than that. If you don't meet it, what's the thing? If we give you the money or promise you the money,
You have to give some back.
you have to give it back, and that has to be in there. There are two things I said: right of return, okay, or right of return, or you don't have to pay it. If both you don't meet the tests, and another example is not just that, but if you have to see a certain number of people, or you have to attain some goal, they call it milestones, they call it a lot of different things. That is a condition. That's clearly. And in the past, it was treated a different way, but they clarified that very, very, very much here. So who is really the recipient of it? And depending, it gets treated different way. The ultimate customer is the public, or is it the government? Okay, and basically, as I said, the government's a third party. So if they're not a party, it's not an exchange transaction. Now we just have to see if there's a condition. It gets tilted not as a contract between that I have to meet it, but as either a conditional or a restricted or without donor restricted contribution. Okay? If it's an exchange transaction, you have to follow what we're going to talk about if we have a little time, which we're going to be close on, what they call revenue recognition rules that came out, which is a major update. So you have to follow those rules. It's Accounting Standards Codification 606. Otherwise, it doesn't apply. Okay? A great example, you gave one, I'll give you another one. I reimburse you for Medicaid. To me, that's a clear payment per service. That's an exchange transaction to me. But hey, I got some other examples. And by the way, these aren't mine. The FASB was very good. I clarified a little bit, but I took this right out of the update. So the government gives a not-for-profit $100,000 to perform a study of the benefits of a longer school year. Of course, you don't want to tell your kid this, but they said, as any of you that know in a lot of foreign countries, that our year is much smaller. So this is a legitimate study, okay? But the government, after you get the study, they have the rights to the study, meaning they publish it. Contribution, exchange transaction. In this case, clearly an exchange transaction. Why? Because the government is the party here. You're clearly doing something, okay? It's not the public. Same set of facts, okay? But the not-for-profit gets, you're paying them, they have the study, they publish it. The not-for-profit is doing something for the public. This is not an exchange transaction. This is treated like a contribution. Conditional or restrictive, but nevertheless a contribution. Another example, because these are the ones that are going to come up, and I thought it was important to give you a bunch of options and examples. Example 3, $500,000 government grant. If it's contribution, you pick up the full amount. It's without donor restriction. WDR in the bottom is with donor restriction or without donor restriction, WODR. I gave you on the bottom a little definition. So if it's basically without any restrictions on it, and no conditions, you pick it up as cash or grants receivable, some receivable, and income, because there is no condition here. And if there was a restriction, it'd be with the restricted. If it's a fee for service, the government is paying for that study. Okay, you didn't earn it until you did that study. I gave you the money up front, but you haven't even started on it. You do not book it. But if it's a contribution, you would book it. You see the difference? It can make a difference of booking or not booking. So here's an example with the Medicaid. Okay, you must here's 500,000. Okay, I saw 5,000 patients. $75 that I get for each patient. I don't pick up the 500. I have to do a service. I get 375. In the first case, I pick up the whole 500. In my third case, okay, which is really confusing to a lot of people, but it's very important. Most government grants are tilting this way. The government got smart. You know, we work on a cash flow too. And so you know what we're going to do? We're going to give you the money after you spend it, which will make you, like, you know, manage your money better. So what if the contract, the agreement, and by the way, you can call it a contract, you can call it agreement, you can call it whatever you want, a grant. It doesn't make a difference, by the way. People say, oh, it says it's a contract, so it's an exchange. Forget what they call it. Look at the details of the agreement. If the agreement says that you have to spend the money, wouldn't that be a condition? You have to spend the money first. So even though it's not an exchange transaction, it becomes a conditional type of contribution. And until you spend the money, which many times means I submitted my bill, my report to the grantor. By the way, if you could prove I spent the money, you can even book it before you submitted the report. A lot of auditors don't like this because you can't support it. But you could support, we spent that money. Here it is. You could see the bills. It's clearly for that. You can then pick up the receivable because you spent the money. But usually it's when you submit the bill. Okay? Makes a big difference. That's all I'm going to say about that. It really clarifies a lot. It's really the old rules, but again, with the government being a different. Okay, and again, I'm going to stick around if you have questions on that. Okay, revenue from contracts with customers affects every single organization in the country and is really, really a big update, this big. It's great to, you know, if you have a grandkid and you need to boost them up on their booster seat, it's a great thing to put on the seat. It really is thick. And you got to be crazy to read this thing. But it has so many pieces to it about whether you pick up something as earned. And this has to do with exchange transactions, contracts. And in the past, if you had an agreement with somebody to buy something, you booked it, or you did, you know, okay, I have an agreement. I book it up as either revenue if I'm getting the money, or I book it as an expense. They really delved into the reeds on whether you pick up. And guys, it doesn't affect not-for-profits as much, but if you are an organization that has programs and you charge for them, and it could be cultural, museums, it could be schools, or a program, after school, a camp, you know, any of this, and you have agreements, if you don't follow these rules, you cannot book it. You're actually booking things on a cash basis, not on an accrual basis. It used to be, not that you care, but they changed it because it was so much, they actually had to change one of the accounting standard codification. It used to be under 605. They created a new number, 606. Not that you care. But it's effective for years beginning after last year, which means this year. So this one, the other rule is effective. The other rule is effective for 2018. This one is going to be when we're in 19 for the 19 years. It's going to be for years beginning after 18, which is 19, which means you're going to have to worry about this next year. I'm just giving you the gist of it, guys. I could tell you on this update alone, you could take a 4-5 hour if you were really wanted to delve into the weeds on what this covers, because there's a lot of examples. And it gets very complicated because there is, especially if your organization is producing something. I used to be a chairman of an organization in Brooklyn, blind and sight impaired, and they produced a lot of brooms and garments for the military. And so they were a factory. And it was a great thing they were doing. But they had contracts to sell with the government agencies and the government services. And so this really affects them. So basically, here's the core. You recognize revenue after the transfer of promised goods. I promise to give you these goods or services to a customer in an amount that reflects the consideration that an entity expects to be entitled to. That sounds like a mouthful, but basically it says, I recognize my income as I do the service or as I give them the product, based on our agreement to how much that's worth in the agreement. The problem with a lot of these agreements is they cover a lot of pieces of the service and products, which means that you have to separate this, and that's where the devil is. You have to bifurcate. How much do I earn for this service or for this product? And it's no more you just say, oh, I did a quarter of our order. You have to really do a lot of calculation. What does it not include? Okay? Actually, I'll talk about that in a second. Let me, what it doesn't include, but for the most part, what does it include? I said tuition, medical subscriptions. That's going to be a problem for membership organizations. You know, you're a member and you get a subscription. Subscription is an exchange transaction. The membership could be over whatever period. So, as we're going to give an example. So when do I pick up the revenue for membership? When do I pick up the revenue for that part of its subscription? And it's not a really large number, dollar-wise, but it can be a pain in the ass, especially if you have a lot of members. So subscription sponsorship. This is why I changed my approach to picking up that sponsorship as a contribution or exchange transaction. If it's an exchange transaction, it follows these rules here. And do I have agreements? And how many times does a sponsor give you, you have an agreement that they're going to give you $10,000 to be a platinum sponsor, which gives them a table and this. And when are they getting the benefit? At the event? A month before the event? 3 months before? So that's why I'm changing my approach on that. Government and foundation grants that say you have to deliver, meaning I have to produce something. Membership dues I just mentioned, royalties and licensing. All of this goes under the new rules. Okay? The effect of this update says, again, it's setting next year, but before you could pick up a number, you must meet certain criteria. Each one of these has 100 pages. That'll give you some idea. But here's like a summary. And you must meet these 5 tests before you can book anything. So if I have members and I'm a membership organization, I got to apply this to know when I pick. I can't just like go, oh, I'll prorate it and do that. You have to identify the contract with the customer. And what does that mean is, for the most part, it should be in writing. It doesn't absolutely say it has to be, but it's basically saying it has to be. Identify the performance obligations. What does the not-for-profit have to do to get the money? Product or service. Determine the transaction price. Let's go back to the membership. My membership's $500. What is related to being a member, and what's related to the subscription or anything else I'm getting? That's the actually, I take that back. The transaction price is the 500. The next one is allocating the transaction price to the performance. So how much goes to the membership and how much goes to the subscription. And then what we would do, a lot of us who are the bookkeeper's account, when do you actually recognize the performance obligation? What point do you do it? You have to do the first 4 before you do the 5th. Okay? Again, I told you it's effective this year, which means we'll be doing it next year. It doesn't affect not-for-profits as much. It's going to be a little bit of a bookkeeping nightmare, all right? So you can read this as, on your own, but basically, here's your exceptions. Leases are excluded from this. Otherwise, that would be a contract. Insurance contracts excluded from this. Financial instruments, contracts to be brokers, and guarantees, and certain non-monetary exchanges like contributions. That follows the other rule. Now, to qualify as a contract, okay, you have to follow these 5 steps. Identify the contract with the customer. Identify what you have to do, program-wise, service, products. Determine how much money you're getting paid. That's not always so easy. I'll pay you this amount if you do this, but if you get it done earlier, I'll pay you a little more. That all has to be factored in. Allocate the price between my accomplishments for doing the service or the product, and then actually recognizing it. It's going to affect a lot of a consultant. You're hiring a consultant to be a fundraiser, to be a computer consultant. You better have in there what the consultant's going to do, and it better meet. You're going to have these 5 things. Or now that's on the paying side. But let's say somebody's hiring the not-for-profit to do this. You have to identify they're hiring the organization to be the consultant or the advisor. They have to determine all of this. Okay? I'm going to stop there. Like I said, there's a lot in here. And most of you are still awake, and I thank you for that. So I'm going to really quit while I'm ahead and finish you off with this one. Leases. Fortunately, this is for years beginning after 12/15/19. Now, why do they have 15 in December? Because nobody has a fiscal year in the middle of December, so they're pretty safe. So it's years beginning after that, which means 2020, guys. Which means, are you going to be worrying about it in 20? Probably, but really worrying about it in 21 when you have to do the financial statements. So here's the synopsis of this. What is it saying? It's saying you now have to treat operating leases, which is your rental leases and equipment leases, like a capital lease. For those that remember the old accounting rules, you only capitalize the lease if you had 90% of the value and used up and blah, 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 and bargain purchase at the end of $1. Now, for accounting purposes, if you have a lease, you have to capitalize it if you have exclusive use. So what does that mean? It means you basically are picking up an asset and a liability. And this is what's going to give everybody a headache. It's going to inflate your assets, it's going to inflate your liabilities, and at the end, it's not going to change your net assets, but it's going to disclose that. So, in the past, all you had to do, and I'm going to finish up quickly, we have a couple minutes. In the past, you guys remember, in your notes, you had to disclose what your commitment was and said, here are the following minimum payments we have on our lease going out for the remainder of the lease. You had to identify the top 5 years and all the others. And so the reader knew I was committed, that if I closed up, I have a commitment. I'm breaking a lease. So it's a commitment. Now you get rid of that note, and now you actually put it right on the statement of financial position. So that was the old note down there, the example of the old note in the notes. Okay, the new note says you're now going to have an asset called an operating lease, right of use asset. You could call it operating lease, you can call it whatever. On the liability side, you're going to say operating lease liability, as long as it's non-cancelable, meaning you can't break it at any time, okay? You must apply a discount because it's going over several years, so you have to bring it back. What's the total amount of the lease? That's not so clear cut, because sometimes I get 6 months free. Sometimes there is escalation. Each year it will go up 2-3%. Sometimes I have to lay money out, and the landlord will kind of rebate it back in the lease. I had a landlord that did that for cash flow. You lay it out, and I'll reduce your rent. So you have to figure all the pieces to determine what the amount is. And then you book the right of use and the liability. And then you do the same old rules. You allocate the expense based on a straight line method, which was the old rules, okay? And then you have to basically reduce the asset and reduce the liability and continue that way. Instead of telling you theoretically, let's take a real quick look at this, and we're going to call it a night, a day. Feels like a night. So here you have 3 years, year 1, year 2, year 3, escalation, discount rate. There's your total payments. There's your present value. There's your straight line lease expense. Here you're booking. It's not $40,200, it's $36,000, okay? That's what you're booking. And here's your wonderful bookkeeping entry that I'm sure I'm going to get a lot of calls about, how to do this and how to set it up. You guys can have fun. You have a little while. You could early adopt. I can ask real quick who's going to early adopt, but I already know the answer. So nobody's going to early adopt. But you have a couple of years to do that. And on that note, the end. Thanks, guys.